This video is part of an invested series. I recommend you start at the very beginning. I'll leave a link in the description below. If you just want the ticker symbol or stock symbol, which is the abbreviation you need to use to actually buy the stock, then you can skip to this part of the video here. But I highly recommend you watch this video all the way through because it's important to understand why this stock is so dang powerful. I'm Sean, a computer scientist working in AI with a passion for investing, and in this video you will learn the one stock you ever need to invest in. Before we dive into the best stock you should invest in, let's quickly go over what a stock is. A stock is an investment that represents an ownership of a company. If you buy a stock at a certain price, the price of that stock goes up, and you sell at that higher price, then you just profited. The stock market is one of the best places to invest, hands down. The market always goes up time and time again. Even through all of the economic disasters and dips, the market relentlessly goes up. But even though the market generally goes up, people lose money on the stock market. Why is that? Mistake number one is that people try to time the market. They sell when they are panicking, and so they sell low, and then people generally buy when the markets are high, stable, and soaring. It's just how it works. We feel more confident buying investments when times are great. Mistake number two is that we believe we can pick individual stocks. Everyone and their mother speculates on stocks. They talk about the next biotech company that's going to cure cancer or the next weed company that's going to explode. And while of course you do hear stories of people making hundreds of thousands of dollars speculating on stocks, there are way more stories of people losing a ton of money. Your baseline that you should be comparing your growth to isn't 0%. You should not be happy if you put in money into the stock market and you didn't lose or gain any money. Your baseline should actually be the growth of the stock market itself. And decades over time, the annualized return or the yearly return of the stock market has been about 10 to 11%. 95% of financial professionals can't actually beat the stock market. So what makes you any better? Now, I'm not gonna lie, when I first got started with investing, I was investing in individual stocks and it was a ton of fun. There were times when the companies I invested in were up and it's a huge rush. Trying to pick individual stocks is addicting. Kind of like cocaine. However, if investing in individual stocks is what gets someone interested and excited about investing, I am all for it. Just take that money that you lose as the price of learning. For me, when I learned that 95% of investors who spend all day, every day researching stocks can't even beat the market, it really humbled me. To add to this point, Warren Buffett, who was deemed the most successful investor in the entire world, challenged 5 hedge fund managers over the course of 10 years. Hedge funds being an exclusive partnership of investors who use complicated investing strategies to hopefully realize large capital gains. These hedge funds take money, borrow money, charge fees, and promise large profits. The challenge started in 2008 and the hedge funds took off. At the beginning, the hedge fund investment decisions were outpacing Warren Buffett's choice of investment. But things didn't end up happily for the hedge funds. The hedge funds picked individual stocks that they believed would grow way faster than the market. And over the course of 10 years, the hedge funds averaged about an increase of 36%. Warren Buffett's pick, the S&P 500 index fund. Low-cost index fund just tracks the top largest companies within the US, no more, no less. Buffett's investment grew 125.8% over the course of 10 years. What's the conclusion of Buffett's challenge? You can't consistently pick winning stocks. And if you are that anomaly that accomplishes this for 30, 40 years, you are a fucking wizard. So what do we do if we shouldn't invest in individual stocks? Well, we take Buffett's approach for this challenge and invest in low-cost index funds. Specifically, what I'll be talking about in the rest of this video will be the total US stock market index fund. What's in the total US stock market index fund? Every publicly traded company in the United States. Every US company that can be bought and sold on the stock market is in this fund, and there are about 3,500 companies. Investors and financial advisors always mention the term diversification. And in terms of investing in stocks, you pretty much can't get any more diversified than this. The reason why we diversify is because we don't want to have all of our eggs in one basket, because if that basket tanks, then we lose all of our money. By diversifying and splitting up our money across different areas, in this case, across a bunch of different companies, Then we're safe when sometimes companies go bankrupt or they lose in value, while all the other companies can also grow as well. Therefore, diversifying while still realizing gains. Diversification not only makes sense in a financial sense for investing, but also when you're working out. You don't want to just do that one exercise over and over again, like, let's say body squats, and that's the only exercise you do. No, you want to include some upper body, some back, some chest, some other exercises that overall increase your bodily health. With the total US stock market index fund, there isn't an equal distribution of companies within the fund. It is a market capitalization weighted fund, which in simple terms means that the large US companies make up the majority of the fund, the mid-cap companies make up a minority of the fund, and the small companies make up a tiny sliver. And why does the incorporation of mid-sized small companies matter to you? Well, for added diversification, and on top of that, because mid and small cap companies over the long time grow at a faster pace than large cap companies. The fund also spreads across all sectors of the market, including technology, financials, and healthcare. On top of producing better results than 95% of financial professionals out there, the fund almost takes no time at all and allows you to focus your time on other aspects of your life that make life more meaningful. Simplicity is something that you should not overlook. Investing doesn't have to be complicated, and you don't need professional advice. Unless you're a money weirdo like me, you're much better off spending your time elsewhere. In fact, the #1 reason why people's investments are subpar is because they get involved. The human factor takes part. People speculate on individual stocks, they try to time the market, and they panic sell when times are tough. Fidelity's investment research firm did a study where the best performing investment accounts were from those people who had literally forgotten about their investments. Take the human influence out of investing. Having one fund you buy simplifies things significantly. You can set up automatic contributions into an investing account, and you can set up automatic purchases of a total US stock market index fund as well. All you have to do is take a few minutes to set it up, and you don't have to manage it for years and potentially decades. I'm a huge advocate for creating a life around what you value, and if managing money and dealing with all of this personal finance stuff doesn't interest you, then investing in this one index fund is the perfect choice for you. Low-cost index funds are way better than those expensive mutual funds. You should be happy with the return of the stock market. It's actually pretty great. The only thing we can do on our part is to lower the fees associated with the fund. A mutual fund will typically have a 1% fee. This fee helps pay for the fund management, pay for expensive staff who does research on individual stocks, and to pay for fund managers to fly out and meet company executives. Whereas a low-cost index fund will typically have a 0.03% fee. Now, 1% might not sound like a lot, but compounded over decades will result in you having huge losses, potentially hundreds of thousands of dollars. Keep expenses low. Now, you might be wondering about international stocks like the Samsungs out there that you want to invest in. There are 3 main reasons why you might not want to invest in international stocks. One being there's added risk. Investing in a company in a country with an unstable government has an added risk to it. A country's economic development is closely tied to the country's government. The second reason why you wouldn't want to invest in international stocks is because there's added expense. Now, for funds that have international stocks, they'll typically have higher expense ratios, therefore cutting away at your profits. And lastly, within a US total stock market index fund, we already have international stocks. Think about the Apples, Google, Facebook, Coca-Colas. These are all US companies, but they expand across the entire world. I'll throw up a chart where you can see the influence of these countries across the world. Almost half of their profits are from outside of the United States. All right, so we just learned a lot of reasons why this is the only stock we need to invest in. So how do you actually purchase this stock? Here's what you need to know. There are options from a lot of different investment companies, and I'll go through several of them. If you invest through Charles Schwab, there's the Schwab Total Stock Market Index, SWTSX, with a 0.03% expense ratio. This expense ratio is the fee you pay annually. If you invest through Fidelity, there's the Fidelity Zero Total Market Index Fund, FZROX, with a 0% expense ratio. But you have to invest through Fidelity. If you invest in another platform such as Robinhood, M1 Finance, or Webull, 2 options for you are the iShares Core S&P Total US Stock Market ETF, ITOT with a 0.03% expense ratio, and Vanguard's version VTI, which also has a 0.03% expense ratio. ITOT and VTI are ETFs that are bought like stocks. So if you have enough money to buy one share of it, then you can purchase it. But if you're just a penny off, then you can't purchase that share. If you have $3,000, then you have the options to invest through Vanguard's fund VTSAX or VTSAX. This covers the same total stock market and has a 0.04% expense ratio. Now this expense ratio is slightly higher than the 0.03 of VTI, but allows you to fully invest all of your money, meaning that if you have $3,000, you can invest the $3,000 fully into the fund. You will just have a fractional share of that fund. It doesn't really matter which one you choose, they all produce strikingly similar results, which is no surprise because they all track the same index of the US total stock market. While this is the only stock you really need to buy, there is something that you should consider purchasing as you get closer and closer to retirement, and that is bonds. Bonds are an investment option that are a lot more stable than stocks, but don't produce the same return as them. So if you're a beginner investor, you have a long time horizon before you retire, you should go 100% into stocks. But this of course should be based on your own risk tolerance. But as a beginner, relatively young investor, it's better to be aggressive and then become less aggressive by adding in bonds while you get closer and closer to retirement age. In other words, go full send on stocks. Pop the like button to support this channel, hit the notification bell so you know when the next investing video is up, and I'll see you all in the comment section below. Peace.